Question 1. Which of the following is a distinguishing characteristic of a health maintenance organization, HMO? A. Members can receive care from any provider they choose. B. Emphasis on preventive care and cost containment. C. Higher out-of-pocket costs compared to other plans. D. Fee-for-service reimbursement to physicians. Answer: B. Emphasis on preventive care and cost containment. HMOs are known for their focus on keeping members healthy through preventive services, which in turn helps control healthcare costs. They often require members to choose a primary care physician, PCP, who coordinates their care and may need referrals to see specialists. This structure aims to manage costs and promote early intervention. Think of an HMO like a managed healthcare system that prioritizes keeping you well to avoid expensive treatments later. Question 2. What is the primary purpose of a life insurance policy's grace period? A. To allow the insurer time to investigate a claim. B. To provide additional coverage without an increase in premium. C. To prevent unintentional lapse of coverage due to a late premium payment. D. To enable the policy owner to make changes to the policy. Answer: C. To prevent unintentional lapse of coverage due to a late premium payment. The grace period in a life insurance policy is a specified timeframe after a premium due date during which the policy remains in force even if the premium hasn't been paid. This prevents the policy from lapsing immediately due to an oversight or temporary financial difficulty. It gives the policy owner extra time to make the payment and maintain continuous coverage. Remember the grace period as a safety net, preventing your life insurance from ending immediately if a payment is slightly delayed. Question 3. Which type of annuity is designed to provide a guaranteed income stream for the life of the annuitant? A. Variable annuity. B. Fixed annuity. C. Equity indexed annuity. D. Immediate annuity. Answer: B. Fixed annuity. A fixed annuity guarantees a specific rate of return and provides a predictable income stream for a set period or the annuitant's lifetime. The insurance company bears the investment risk, and the payout amount remains constant. This makes it a conservative option for those seeking financial security in retirement. Picture a fixed annuity as a reliable paycheck arriving regularly, no matter what happens in the market. Question 4. What is the purpose of the Medical Information Bureau, MIB? A. To provide free health screenings to insurance applicants. B. To track the medical history of all U.S. citizens. C. To help insurance companies detect fraud and assess risk. D. To resolve disputes between policyholders and insurers. Answer: C. To help insurance companies detect fraud and assess risk. The MIB is a non-profit organization that maintains a confidential database of medical information on individuals who have applied for life, health, or disability insurance. Insurers use this information to verify the accuracy of an applicant's medical history and identify any potential misrepresentations or undisclosed conditions, which aids in fair risk assessment and fraud prevention. Think of the MIB as a shared information resource that helps insurance companies make informed underwriting decisions. Question 5. In Michigan, what is the minimum age at which a person can enter into a life insurance contract on their own life? A. 16. B. 17. C. 18. D. 21. Answer: C. 18. In Michigan, as in most states, the legal age of majority is 18. This means that an individual must be at least 18 years old to enter into a legally binding contract, such as a life insurance policy, on their own life without the consent of a guardian. Remember that the age of 18 generally signifies the ability to make independent legal decisions. Question 6. Which of the following best describes the principle of indemnity in insurance? A. The insured should profit from a loss. B. The insured is restored to the same financial condition as before the loss. C. the insurer will always pay the full amount of the loss. D. The insured can collect from multiple policies for the same loss. Answer: B. The insured is restored to the same financial condition as before the loss. The principle of indemnity aims to put the insured back in the financial position they were in before a loss occurred, without allowing them to profit from the loss. This is a fundamental concept in insurance, preventing individuals from benefiting financially from an insured event. Think of indemnity as making you whole again after a covered loss, but not better off. Question 7. What is a rider in an insurance policy? A. An exclusion that limits coverage. B. A provision that increases the premium. C. An amendment that expands or modifies the policy's basic coverage. D. A document outlining the insurer's financial rating. Answer: C. An amendment that expands or modifies the policy's basic coverage. A rider is an optional add-on to an insurance policy that changes the terms or scope of the original coverage. Riders can provide additional benefits, such as accidental death or disability income, often for an extra premium. Consider a rider as an extra feature you can add to your base insurance policy to customize it to your specific needs. Question 8. Which of the following types of life insurance policies provides coverage for a specific period of time and then expires? A. Whole life insurance. B. Universal life insurance. C. Term life insurance. D. Variable life insurance. Answer: C. Term life insurance. Term life insurance provides coverage for a defined period, or term, such as 10, 20, or 30 years. If the insured dies within this term, the death benefit is paid to the beneficiaries. Once the term expires, the coverage ends without any cash value accumulation. Think of term life as renting coverage for a specific time frame. Question 9. What is the waiting period in a disability income insurance policy? A. The time between policy purchase and the start of coverage. B. The period after a disability begins before benefits are payable. C. The duration for which benefits will be paid. D. The time allowed to file a claim after a disability occurs. Answer: B. The period after a disability begins before benefits are payable. The waiting period, also known as the elimination period, in a disability income policy is the time that must pass after the onset of a disability before benefit payments begin. It acts like a deductible in health insurance. The longer the waiting period, typically the lower the premium. Understand the waiting period as the initial time frame you need to be disabled before the insurance company starts sending payments. Question 10. Which of the following is not a responsibility of an insurance producer in Michigan? A. Acting in the best interest of the insurer. B. Soliciting insurance. C. Negotiating insurance policies. D. Providing advice on insurance coverage. Answer: A. Acting in the best interest of the insurer. While insurance producers represent the insurer, their primary ethical and legal responsibility is to act in the best interest of their clients. This includes recommending suitable coverage and providing accurate information. Producers must prioritize the needs of the policyholder when advising on and selling insurance products. Remember that a producer's duty is first and foremost to the client. Question 11. What is the cash surrender value of a life insurance policy? A. The total amount of premiums paid into the policy. B. The amount paid to the beneficiary upon the insured's death. C. The amount the policy owner can receive if the policy is cancelled. D. The annual dividend paid to the policy owner. Answer: C. The amount the policy owner can receive if the policy is cancelled. The cash surrender value is the accumulated cash value in a permanent life insurance policy that the policy owner is entitled to receive if they decide to terminate the policy before the insured's death. This value builds up over time due to premium payments and interest earned. Think of the cash surrender value as the savings component within certain life insurance policies that you can access if you cancel the policy. Question 12. Which of the following is a common exclusion in a health insurance policy? A. Routine doctor visits. B. Hospital stays due to illness. C. Injuries resulting from acts of war. D. Prescription medications. Answer: C. Injuries resulting from acts of war. Health insurance policies typically contain exclusions, which are specific conditions or circumstances for which coverage will not be provided. Injuries resulting from acts of war are a common exclusion due to their unpredictable and potentially widespread nature, which could strain the insurer's financial resources. Insurers generally avoid covering events of this scale. Question 13. What is the purpose of an assignment provision in a life insurance policy? A. To allow the beneficiary to be changed. B. To transfer ownership of the policy to another party. C. To specify how the death benefit will be paid. D. To outline the insurer's right to contest a claim. Answer: B. To transfer ownership of the policy to another party. An assignment provision in a life insurance policy allows the policy owner to transfer some or all of their rights in the policy to another individual or entity. This might be done for various reasons, such as using the policy as collateral for a loan. Understand assignment as the legal process of changing who controls the insurance policy. Question 14. Which of the following describes a guaranteed renewable health insurance policy? A. The insurer can cancel the policy at any time. B. The insurer can increase premiums on an individual basis. C. The policyholder has the right to renew the policy until a specified age, with premiums possibly increasing by class. D. The policy's benefits and premiums are fixed for the life of the policy. Answer: C. The policyholder has the right to renew the policy until a specified age, with premiums possibly increasing by class. A guaranteed renewable health insurance policy ensures that the policyholder can continue the coverage until a certain age, as long as premiums are paid. However, the insurer retains the right to increase premiums for an entire class of policyholders, not just for an individual. This provides renewal security while allowing the insurer to adjust rates based on group experience. Question 15. What is the role of underwriting in the insurance process? A. To handle and pay claims. B. To market and sell insurance policies. C. To assess risk and determine insurability. D. To provide customer service to policyholders. Answer: C. To assess risk and determine insurability. Underwriting is the process by which an insurance company evaluates the risk associated with an applicant and decides whether to issue a policy and at what premium rate. Underwriters analyze various factors, such as health, lifestyle, and financial history, to determine the likelihood of a loss. Think of underwriting as the insurance company's risk assessment department. Question 16. Which of the following is a feature of a universal life insurance policy? A. Fixed premiums and a guaranteed death benefit. B. A cash value component that grows based on a fixed interest rate. C. Flexible premiums and an adjustable death benefit. D. Investment control over the cash value account. Answer: C. Flexible premiums and an adjustable death benefit. Universal life insurance offers flexibility to the policy owner in terms of premium payments and the death benefit amount, within certain limits. The policy also has a cash value component that grows on a tax-deferred basis, typically tied to current interest rates. This flexibility allows the policyholder to tailor the coverage to their changing needs. Question 17. What is the purpose of coordination of benefits, COB, in health insurance? A. To ensure that multiple insurers pay claims in the correct order and prevent overpayment. B. To allow policyholders to choose which insurer pays first. C. To reduce the overall cost of healthcare premiums. D. To simplify the claims filing process for individuals with multiple policies. Answer: A. To ensure that multiple insurers pay claims in the correct order and prevent overpayment. Coordination of benefits is a process used when a person is covered by more than one health insurance plan. It determines which plan is primary and which is secondary, ensuring that benefits are paid appropriately and that the total reimbursement does not exceed the actual expenses incurred. This prevents someone from profiting from having multiple insurance policies. Question 18. What is a non-forfeiture option in a life insurance policy? A. A provision that allows the policy owner to reinstate a lapsed policy. B. A clause that prevents the insurer from contesting a claim after a certain period. C. Options available to the policy owner regarding the cash value if the policy lapses or is surrendered. D. A rider that provides additional coverage in the event of accidental death. Answer: C. Options available to the policy owner regarding the cash value if the policy lapses or is surrendered. Non-forfeiture options are provisions in whole life insurance policies that protect the policy owner's cash value if they stop paying premiums. Common options include taking a reduced paid-up policy, extending the term coverage, or receiving the cash surrender value. These options ensure the policy owner doesn't lose all the accumulated value. Question 19. Which of the following best describes the concept of insurable interest? A. The financial stability of the insurance company. B. The legal right to sell insurance policies. C. A financial loss that would be suffered upon the death or disability of the insured. D. The insured's understanding of the policy terms and conditions. Answer: C. A financial loss that would be suffered upon the death or disability of the insured. Insurable interest exists when one person has a legitimate financial stake in the life or health of another person. This is a fundamental principle of insurance to ensure that policies are not purchased for speculative or wagering purposes. For a life insurance policy to be valid, the policy owner must have an insurable interest in the insured at the time the policy is purchased. Question 20. In Michigan, what is the typical free look period for a life insurance policy? A. 7 days. B. 10 days. C. 20 days. D. 30 days. Answer: B. 10 days. In Michigan, life insurance policies typically include a free look period, which allows the policy owner a certain number of days after receiving the policy to review it and return it for a full refund of premiums if they are not satisfied. The standard free look period is often 10 days, but it can vary slightly depending on the specific policy and insurer. This gives the buyer time to make sure the policy meets their needs. Question 21. What is the difference between a revocable and an irrevocable beneficiary designation? A. A revocable beneficiary can be changed by the policy owner without the beneficiary's consent, while an irrevocable beneficiary cannot. B. An irrevocable beneficiary receives the death benefit before a revocable beneficiary. C. A revocable beneficiary designation is more common in group life insurance policies. D. An irrevocable beneficiary designation requires a higher premium. Answer: A. A revocable beneficiary can be changed by the policy owner without the beneficiary's consent, while an irrevocable beneficiary cannot. A revocable beneficiary designation means the policy owner has the right to change the beneficiary at any time without needing the current beneficiary's permission. In contrast, an irrevocable beneficiary designation means the policy owner cannot change the beneficiary, borrow against the policy's cash value, or make other policy changes without the irrevocable beneficiary's written consent. This offers the beneficiary more security. Question 22. Which type of health insurance plan typically has a network of providers that the insured must use to receive the highest level of benefits? A. Indemnity plan. B. Preferred Provider Organization, PPO. C. Health Savings Account, HSA. D. Disability income insurance. Answer: B. Preferred Provider Organization, PPO. PPOs have a network of doctors, hospitals, and other healthcare providers that have agreed to provide services at discounted rates. While PPO members can often receive care from out-of-network providers, they typically pay higher out-of-pocket costs compared to using in-network providers. This structure offers more choice than HMOs but still encourages the use of network providers for cost savings. Question 23. What is the primary purpose of the incontestability clause in a life insurance policy? A. To limit the time the insurer has to challenge the validity of the policy based on misstatements in the application. B. To allow the policy owner to contest premium increases. C. To prevent beneficiaries from contesting the death benefit amount. D. To establish the procedures for filing a claim. Answer: A. To limit the time the insurer has to challenge the validity of the policy based on misstatements in the application. The incontestability clause states that after a certain period, usually 2 years, the insurance company cannot contest the validity of the policy based on misrepresentations or omissions in the original application. This provides security to the beneficiary that the death benefit will be paid, even if there were unintentional errors in the application, after this period has passed. It encourages honesty during the application process while offering eventual protection to the policyholder. Question 24. Which of the following is a characteristic of a variable life insurance policy? A. A guaranteed minimum cash value. B. A fixed death benefit amount. C. Investment control over the cash value account. D. Premiums that remain level throughout the policy's term. Answer: C. Investment control over the cash value account. Variable life insurance policies allow the policy owner to allocate the cash value among various investment options, such as stocks and bonds. The cash value and the death benefit fluctuate based on the performance of these chosen investments. This offers the potential for higher returns but also carries investment risk. Think of variable life as combining life insurance with investment opportunities where you make the choices. Question 25. What is the purpose of a spendthrift clause in a life insurance policy? A. To prevent the policy owner from borrowing against the cash value. B. To protect the death benefit from the beneficiary's creditors. C. To allow the insurer to delay payment of the death benefit. D. To designate a contingent beneficiary. Answer: B. To protect the death benefit from the beneficiary's creditors. A spendthrift clause is designed to prevent the beneficiary from recklessly spending the life insurance proceeds and to shield the death benefit from claims by the beneficiary's creditors. It ensures that the beneficiary receives the funds as intended, providing a measure of financial security. Consider a spendthrift clause as a safeguard for the inherited money, protecting it from potential financial mismanagement or legal claims against the beneficiary.